Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk about a topic that's really for those of you that are equity investors. So for anyone here who buys or sells any or invests in stocks, ETFs, or ETNs for the long run for your portfolio, even if you hold them for relatively short periods of time, these are the option strategies that you can utilize to enhance those stock and ETF positions to help you buy those stocks that you want to purchase at a discount or at a lower cost basis. And then as you hold on to those holdings, think of your stocks and ETFs as assets that you hold, and you can utilize those assets to utilize options and extract more yield. So stocks and ETFs that you hold in your portfolio, perhaps they pay you dividends on some of the dividend paying ones, but for some of them, they may not pay you any dividends. So how can you still extract yield from those equity assets? That's what we're here to talk about. So predominantly, we're going to talk about two strategies: selling cash secured puts and selling cover calls. This is a great addition to the topic that we recently covered on buying versus selling options. On that webinar, we talked about the basics of buying versus selling options, but we didn't talk about a specific strategy. Today, we're here to talk about strategies that you can actually deploy in your portfolio. In my opinion, these are the two most actively traded strategies for most institutional investors, is really selling puts and selling cover calls. There's a reason why institutional investors utilize these two strategies to enhance their equity position. So that's what we're going to go over here today. Now, before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So for the month of December, another relatively short month because of the holidays, today we're here to talk about enhancing your equity positions using options. Again, this is a webinar focused for those of you that are equity investors. Next week, we're also going to talk about equity investments. We're going to talk about longer term investing using leap options. And this is really critical because on December 11th, the following day after next Thursday, we're going to be doing a members only thematic webinar where we're going to discuss longer term themes specifically within cybersecurity, what opportunities in terms of longer term we see within cybersecurity theme. And we're going to show you how you can utilize leap options to take advantage of it. So really trying to weave what we're learning in terms of options education next Thursday with some real thematic trades within cybersecurity the very following day on Friday. So looking forward to doing that here next week. And then the last Thursday of the month before the holidays, we're going to do a 2020 review in terms of where we currently see the equity markets and what our preview for 2021 is to help set you up going into the holidays and the beginning of the new year. So that's what we have coming up here for the month of December. And if you're brand new to Options Play, if you don't have access to any of the tools that we're going to be showing you here today, you can sign up for a free trial at optionsplay.com. I just posted the link into the chat window for anyone who wants to sign up for their free 30-day trial. So today we're going to start off by talking about a strategy that's not actually commonly talked about as a beginner strategy, but in my opinion is actually the most underutilized option strategy by most investors, and that's buying stocks with a discount using a cash secured put. A lot of investors feel that cash secured puts have a lot of risk. They're concerned about the risks that they're taking on when they're selling a cash secured put. But when you actually think about it, versus buying the stock outright using a limit order versus a cash secure put, which one has less risk? It's actually selling the put that has less risk than buying the stock outright. So when you compare the two, you're going to see why you might want to sell that cash secured put next time you want to buy the stock because of the discount factor that provides you. Then we're going to talk about how to add yield to your existing investments. Think about your entire stock and ETF portfolio. How can we help you generate some income off of that? That's exactly what the cover call strategy is designed to do. That's a strategy that many of you are familiar with. So we're going to do a quick review of that. Then we'll talk about what the optimal option strategies are, meaning what are the optimal expiration dates and strike prices. I want to show you the cover call and short put reports that Options Play publishes every single day that you can utilize to actually implement the strategies we're going to teach you here today. We're going to go through some live examples. before we open this up for Q&A here at the very end. So those are the things we're going to go over here for today. Now, the primary question that I want to help investors answer for today's session is really how can options be utilized to add yield to your existing equity investments? So before we get started, I just want to do a quick poll here of the audience. If you could please bring up the chat window, which is at the bottom of your screen, and please type 1 into the chat window if you currently own stocks or ETFs in your portfolio. And please type 2 if you do not own any stocks or ETFs in your portfolio. Okay, so I pretty much see all 1s. I saw a few 2s fly by, but I think the number of 2s, meaning those of you that don't own any stocks or ETFs, are in the very small minority. Now, if you don't own any stocks or ETFs, this may not be the right webinar for you unless you want to start buying stocks or ETFs for your portfolios. So this is, again, the vast majority of you, this has really nothing to do with options trading. We are using options as the tool or the vehicle to help our equity investments. But for those of you that are just trading options, or if you're trading mutual funds, you're trading Forex futures, and you're not buying and selling stocks, this might not be the right webinar for you. Just a quick warning before you spend too much time on this, okay? But again, if you don't own any stocks, but you want to own stocks, then stay put, and we're going to learn a little bit as to how options can help you do that. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you what I believe is the most underutilized option strategy that I see large institutions using day in and day out, that retail investors many times glance over because they're not very sexy. They don't sound very, they're not as sexy as iron condors or credit spreads. They're very plain vanilla options, but that really, in my opinion, is why I think they're most useful and they're very underutilized. So let's go ahead and start with a stock purchase, because every stock portfolio needs to first start with the purchase of some securities, whether that's a stock or an ETF that you want to own. What normally, as a stock investor, the first thing that you do is you buy a stock. Now, most investors will buy that stock using either a limit order or a market order to buy that stock on the open market. So today, what we want to show you is the difference between placing a limit order to buy that stock versus selling a put option to buy that stock. And when you compare the two side by side, you're going to start to see a clear advantage to selling puts as opposed to placing that limit order. So the first example I'm going to give is GM stock. Now, I've been talking about GM for those of you that have been following Options Play for the past few months, since it's trading at about $30. It's rallied up to $45. I still think this is a good stock to buy. So this is a stock I'm going to use as an example. GM, earlier today was trading closer to $45. And let's say I want to purchase 100 shares of this stock at $44. So I want to buy the stock a little bit below the current price. And let's say I have a target price of $50 on this particular stock. So what I want to do is I want to compare buying a limit order, or buying the stock with a limit order, versus selling a put option on this particular stock at the same price that I want to purchase the stock at, which is $44. So if I purchase the stock using a limit order, let's say I want to buy 100 shares of this stock, then to place that limit order, I would need to put up $4,400 in capital in order to place this limit order. Now, that means that I'm risking $44 a share. If I buy the stock and the stock goes down to zero, I'm risking $44 a share. My potential reward is $6 for the $44 worth of risk, because if the stock rallies from $44 to $50, that's a $6 potential reward. And I don't actually have any exposure in GM stock until the stock declines from $45 down to $44 and triggers my limit order. Okay, so that is the side that I think everyone here who answered number 1 is probably familiar with. Now, what I want to show you here is the strategy here on the right, which is selling a put option. Here, what I'm going to do is, instead of placing a limit order at $44, which is my purchase price, I'm going to sell a January $44 put option. Now, for those of you that have gone through your education, you'll remember that selling a put option obligates you to buy the stock at the purchase price, or at the strike price of the short put. Now, if you think about that, the obligation to buy the stock at $44, what does that sound like? It sounds exactly like a limit order. That's exactly what a limit order is actually doing. It obligates you to buy the stock at $44 the second the stock drops below that $44 level. It triggers an order to purchase the stock at the price that you specified. Now, a short put effectively obligates you to the same thing. There are differences between the two, right? A limit order you can place for any amount of shares. A short put has to be for at least 100 shares. So there are some differences. This is not exactly the same, but when the obligation that you have is exactly the same. Now, the difference here is that when you sell a put option, you get paid premium. You get paid the premium of that short put. And that premium goes to offset, number one, the amount of capital that it requires you to sell that put versus placing that limit order. To sell this limit order, I would need exactly $4,400 in cash in my account, or the equivalent of margin in my account in order to place this limit order. But when I sell a put option, I only need $42 a share. So I only need $4,200 in order to sell this $44 put, which obligates me to buy the stock at $44. So my risk is immediately reduced from $44 a share down to $42 a share because I collected that $2 income on selling this put option. What that does is it increases my potential reward from $6 to $8. So I've reduced my risk and I've increased my potential return because I've collected this $2. And until the stock drops below $44, just like the limit order, I have to wait until the stock drops below $44. I can actually continue to sell puts on GM stock until the stock actually triggers and executes or assigns me the stock at $44. And I can continue to actually collect income while I wait for the stock to decline to the price that I want to purchase the stock at. So the net effect of all of this is the fact that by selling a put option, I'm obligating myself to the same obligations as placing a limit order, but because I'm getting paid to place that short put, that gives me a discount on the purchase. In this particular case, it's $2 on a $44 stock, which happens to be about a 4.5% discount. Now, that's a pretty sizable discount. Think and ask yourself. Now, in this particular example, I don't necessarily think that 4.5% is typical, meaning I think that the typical discount that you get is a little smaller than 4.5%. It tends to average between 1 to 3% in terms of a discount, but ask yourself, if you can get a 1 to 3% discount on every stock and ETF purchase in your portfolio, what does that do for your portfolio? The answer is that it's not going to make or break your portfolio. It's certainly not going to be the difference between night and day, but it is going to significantly improve your odds of performance on each individual trade and reduce your risk and increase your potential reward on your stock purchase if you're getting a 2, 3, 4% discount on every single stock or ETF purchase. Does that make sense, everyone? Please type 2 into the chat window if the comparison between placing a limit order and selling a put option makes sense to you. Okay, so I purposely started with a numerical or a real example first to help solidify kind of the opportunity. So let's just review what a short put is. A short put, is designed to allow you to sell a put at the intended purchase price that you were going to place a limit order at. You want to sell a put at the same price that you were originally going to place a limit order at, and it obligates you to potentially buy the stock at the strike price upon expiration. Just like how a limit order potentially obligates you to buy the stock at this limit price, here you have the potential obligation to buy the stock at the strike price. Now, like I said, the difference is the fact that when you sell a put, you have to trade in 100 share increments. So if let's say you only wanted to buy 25 shares of GM, then you're better off just placing that limit order. But whenever you're trying to trade in multiples of 100 shares at a time, selling a put option is the way that you might want to go. Now, when you sell a put, it does require cash or margin in order to sell the put. The same way a limit order requires you to have the cash or the margin before you can place that limit order. But this is a strategy that allows you to acquire the shares, like I said, on average about 2 to 3% in terms of a discount on your stock purchase per expiration. So meaning if the first, if I sell these January puts and the stock doesn't, and I don't have the stock assigned to me, I might sell a February call instead and maybe collect another 2 to 3% by February. And total, by the time that I actually own the stock, I might have a 5 or 6% discount on the actual stock purchase. That's really the key here as to how you can utilize a short put to generate some income for your portfolio. So when you sell a put, there are two possible outcomes. Either the stock is above the strike price at expiration, or the stock is below the strike price at expiration. If the stock is above your strike price, so if in this particular case, if by January expiration, GM is not below $44, it's 45, 46, 47, somewhere above 44, then basically I keep the income, the $2 that I collected on the short put, and I can decide whether or not I want to sell another put. If I do, I effectively can rinse and repeat for additional income. If I still want to buy the stock, maybe I choose a different strike price, collect more income, and I keep doing this until I actually either no longer want to buy the stock, or I've actually owned the stock, which is the second scenario. If the stock goes below your strike price, so if at January expiration, GM is below $44, now I effectively own the stock at the strike price, which is $44 that I sold the puts for, and I minus the premium that I collected, I get the discount on the stock purchase. So when you compare the limit order to the short put, you're getting a discount compared to placing that limit order. So that's in essence what a short put is designed to do. Does that make sense? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 3s. So now let's talk about the fact that you've now owned GM stock. It doesn't matter whether it was a limit order that triggered your purchase of the GM stock, or if you sold that put and now you own the GM stock. But now you do own the GM stock, or maybe you bought it 10 years ago and you just have it in your portfolio. What can you do with that asset that you own in your portfolio? And the answer is you can generate some yield. And I'm not talking about the dividend that you're receiving. You're still going to collect the dividend on the stock that you own, but you can add yield to your stock by selling what we call a covered call. Now, when you think about a covered call, what does a covered call do? It obligates you to sell the stock at a specific price. That's very similar to a limit order that you might put on a stock that you own at the price that you want to sell your stock at. So let's say I own 100 shares of GM. It's trading at about 45 right now, and I have a $50 price target. I think it's going to reach $50. That's when I want to get out of my investment. So as an equity investor, you would simply place a limit order to sell the stock at $50, and you would sit on your investment and wait, right? And during that time, the stock can go up, it can go down, and while it does that, you can collect some dividends if it's a dividend-paying stock. Now, alternatively, as a options investor, you can sell, let's say, a January covered call at the same strike price that you were going to place your limit order for. But now, because when you're selling an option, just like the put option, instead of just obligating yourself to sell the stock at $50, you get paid income to sell that call option. So what that means here is that in the original example here, if I bought the stock at $44 using a limit order, my risk remains the same. If I buy the stock at 44, my risk is 44. My potential reward is still $6, because if I buy it at 44 and sell it at 50, my potential reward is $6 per share. And I will have exposure to GM. So if GM goes up, I make money. If it goes down, I lose money. And I will have exposure to GM, and I will collect dividends until GM rises to $50. As soon as GM rises to $50, I'm out of the trade. I make my $6 on my stock, and I collect whatever dividends it took between the purchase and the sale of the stock. So again, for those of you that are equity investors, that is, I think, pretty clear or pretty straightforward. Now, when you sell a covered call, you effectively obligate yourself to the same thing, which is obligation to sell the stock at $50 sometime, by expiration. But when you're collecting income for it, what you're further doing is you're reducing the risk of your total stock investment, because originally we wanted to buy the stock at 44, but we sold the puts for $2. That brings our risk from 44 down to 42. And now if we sell a call option on top of that, we've reduced that 42 down to 41. So we're further reducing our risk here from $44 a share to $41 a share. And that has the inverse effect of increase our potential rewards, because if now our effective rate of owning the stock is declined to $41 and the stock does rise to $50 that we expected to, we now make $9 a share. So what we've done here is we've reduced our risk and we've increased our potential reward. And during this time, we can continue to generate income each expiration. So the thing about the stock rising from 44 to 50 is that could take 5 months, 6 months, a year. We don't actually know how long the stock's going to take before it goes from 44 to 50. It could take a week or it could take 6 months. Now, as a stock investor, if it does take 6 months, you can collect dividends for 6 months. Now, as a cover call investor, not only do you collect those dividends, but over those 6 months, you can sell multiple cover calls every single month and maybe collect $1 every single month. And what you're doing is every single month you collect $1, you're going to further decrease your risk here, and you're going to further increase your potential reward the longer you hold on to this. So you're going to collect dividends and you're going to collect cover call income. And what this is going to result in is a lower break-even price on the stock that you own, and it generates, at least in this particular example, $3 extra in profits by buying and selling using options versus using a limit order. Now, $3 on a $41 stock is 7.3%. So your return on GM here is an increase by 7.3% by using cover calls and cash secured puts versus limit orders. Now, this is assuming that you get assigned on the short put on the first expiration, and you only sell one cover call before the stock rallies up to that $50 level. Now, in reality, it could take 3-4 months of cover calls before the stock rallies from 44 to 50. So this could actually be closer to 10% or maybe even 12% in additional profits by using a cover call on top of your equity investment. So as you can see here, this is not an option trading strategy. This is really for your stock or ETF investments that you own in your portfolio, and leveraging the ability to sell options to effectively create the same obligations that you have with a limit order to buy and a limit order to sell, but getting paid to place those limit orders. Does that make sense, everyone? Please type 4 into the chat window here. Okay, I see a couple of questions here. Let me see if I can answer a couple of questions. Do you need to buy to close that call you sell? Okay, we'll talk about some of these questions here at the end, but the question is really around how to get out of these trades, and that's something I am actually going to cover here at a later slide. So just to review, what is a cover call? What you're doing is you're selling a call option at the target price that you have on your existing stock position. When you do this, you have the obligation to potentially sell your stock at the strike price upon the expiration date. Now, to sell a cover call, just like selling a cash secure put, does require you to own at least 100 shares of the stock before you can sell a cover call, because each call option you sell obligates you to deliver 100 shares of that stock at that specific price. So you must own at least 100 shares before you can sell this cover call. So this is a strategy that allows you to take profit as the stock rallies significantly. And I have a double asterisk up here, and I'm going to show you why as we go through the examples as to how do you actually go about selecting your strike prices and your expiration dates for the cover call and the cash secured put. But just like the cash secured put, you have two possible outcomes when you sell that cover call. The stock can either be below the strike price or it can be above the strike price. Now, if the stock is below the strike price, effectively the call option will expire worthless, and you can rinse and repeat, meaning you can sell another cover call. So let's say by January, the GM is still below $50. Then what you might want to do is you might want to sell a February $50 call, maybe collect another $1 or maybe $1.50. And that's what I mean by rinse and repeat, right? And if, let's say, by February, the stock's still not above $50, you can sell a March $50 call, maybe collect another 50 cents or $1 or $1.50, depending on where the stock is. That's what I mean by rinse and repeat until maybe by March, the stock does rally above $50. Now you've sold your stock at $50. But maybe at that point you've collected $5, $6 in income. So now instead of just making $5 a share, I'm sorry, $6 a share in profits, you might be making $10, $11, $12 a share in profits because you sold cover call, you sold the cash secured put, and you sold multiple cover calls before the stock reached your target price. Now, once the stock reaches your target price, what's going to happen is you're effectively going to sell your stock at your profit level, at the level that you obligated yourself to, which is the strike price, and you're going to collect the premium of the stock, of the calls that you've sold. So those are the two possible outcomes that you have when you sell a cover call. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. So I see a couple of questions about what are the optimal expiration dates and strike prices, and that's what we're getting to next. So when we talk about these cover calls and cash secured puts, a lot of questions around, so how do you choose expiration dates? How do you choose strike prices? And those are great questions. So first of all, when we talk about expiration dates, the process for selecting expiration dates for both cover calls and cash secured puts are identical. The optimal expiration date is about 45 days to expiration for both cover calls and cash secured puts. So you're going to use the same expiration dates for both strategies. But when it comes to strike prices, this is actually where it differs quite a bit. So when you're selling a cash secured put, you generally want to choose strike prices that are relatively close to the current stock price. So if we're looking at deltas, we're looking at about a 30 to 40 delta, close to the current price of the underlying stock. When you're selling cover calls, you actually want to sell cover calls that are further away from the stock price. So about a 15 to 25 delta. Now, the reason for this is because when you're selling a cash secured put, your primary motive to sell that cash secured put is that you want to you want to own the stock, right? So you can increase your probability of owning the stock by choosing strike prices that are close to the current stock price, because the closer the strike price is to the current stock price, the higher the probability of you owning that stock. And the additional benefit here is that when you sell a cash secured put that's close to the current price, you're going to collect quite a bit of premium. That's where you get the most premium, is that at the money strike, or strike prices that are close to at the money. So not only do you increase your probability of owning the stock, but you also increase your potential discount factor. So when you're selling a cash secured put, always choose strike prices close to the stock price. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. And when you're selling cover calls, you want to do the exact opposite. You want to choose strike prices that are further away. Now, why is that? Good question. A lot of users ask, why do you want to choose strike prices that are far away? And the answer is because most of the risk that you're taking with a stock position is the underlying stock itself. Okay, so let's say I own this GM stock at $42 because I sold the put, and I think the stock is going to go to 50. A lot of people will mention, well, if I sell the $50 call, which is pretty far away, I'm not collecting a lot of premium. But here's the thing: when you're selling a cover call, what do you think is your primary objective? Is your primary objective more income, or is your primary objective to sell your stock at a higher price? And the answer is very, very clear. When we do back tests of this type of strategy, we see a lot of investors will say, no, I'd rather sell the $45 option, because for that, I'm going to collect, let's say, $2 in income, versus the $50 option, I might only collect 50 cents. And someone will say, well, I'd rather take $2 in income than 50 cents in income. But that, in my opinion, is a very short-sighted way of thinking, because what you're giving up here is $5 worth of upside in exchange for $1.50 in income. And that, again, is something that I get questions from all the time from investors saying, I sold a cover call, the stock shot up through my cover call strike, and now I'm not participating on any of the gains. If you relate to that, please type 7 into the chat window if you've ever been in that situation where you've sold the cover call and the stock shoots through the roof, and you realize that you for an extra couple of bucks in income, you gave up $4, $5, maybe $10 in stock upside. And remember, where is the biggest risk that you're taking? The biggest risk is here. For 100 shares of a stock at $42, that's $4,200 worth of risk that you're taking. In order to to account for that risk, in order for to make sense to take on to that risk, you better have a lot of upside. That's the whole reason that you own the stock, is because you think that stock is going to go higher. Do not give up that upside for an extra $1 or $1.50 in income. That's a very short-sighted way of thinking. And unfortunately, I see it so often from investors who sell cover calls too close to the current price, thinking that I want an extra buck or two in income, and exchange gave up $4 or $5 in upside. Don't do that. So when you're selling cover calls, always choose a strike price that's pretty far away. You gotta ask. You have the strike prices. If it doesn't feel too far away, you probably didn't go too far enough. It really should feel like a strike price that the stock has to really shoot through the roof before it can hit that level by expiration. Once you feel that, that's when you've kind of hit the right sweet spot, because the income that you receive is secondary to the capital appreciation of the underlying stock. Always prioritize the capital appreciation of the stock, because that's where it's going to hurt the most when you figure out that you sold a cover call that was too aggressive and you gave up a lot of upside. That's going to hurt a lot more than giving up a dollar or two in additional income. Okay, so does that make sense, everyone? Please type 8 into the chat window if that makes sense to you, because that is probably the hardest lesson to learn from cover call investors. When you learn about cover calls, it's been taught to you as an income generating strategy. So you think to yourself, let me generate as much income as possible. Don't do that. Don't get caught into that income trap. Think about the upside of your underlying stock. So a few tips on top of that. Number one, generally speaking, you want to avoid selling cover calls or cash secured puts going into an earnings event. These are things that pretty much provide a shock to the system. You don't necessarily want to sell cover calls or cash secured puts going into earnings. I generally avoid them. If there's an earnings cycle coming up, either buy it back before the earnings event, or start selling it right after the event. And the second, tip that I want to give you is try to sell cover calls immediately after acquiring the shares. Now, I get the second most common question that I get with cover calls is someone will tell me, I bought a stock at $100, it's dropped to 50 now, it really didn't go my way. How can I sell cover calls to recover my loss? And the reality is that, the $1, $2 in income that you're going to pick up in income is never going to offset the $50 loss that you took on that portfolio, on that stock. There's no chance in hell that selling cover calls when you're down 20, 30, 50% is a good strategy. You have to start selling cover calls immediately after purchasing the stock for this to be a viable strategy for you. If you wait for the stock to drop 20, 30% and then think about trying to generate a little bit of income because you're desperate to try to get back to break even, that is too late, because by that time, once the stock has dropped from, let's say, $100 down to, I don't know, $70, the only cover calls that you're going to generate any income on are probably in the $75, $80 range, which means that if the stock even rallies significantly to $80, you've still obligated yourself to lock in a $20 loss on that stock. So when you're down 20, 30%, not a good time to sell cover calls. Do it when you first get into the trade. That's when you have the highest chance of starting to build that buffer of that stock, so that you are continuously lowering the cost basis from the very beginning. If you wait too long, you might find yourself in a position where it's too late. Okay, so just to remind everyone, Options Play publishes a daily report of all S&P 500 stocks and all of the very liquid ETFs, where we show you the opportunities where you can find the largest discounts on stock purchases using our short put report. So this can be used as an opportunity report to see where can you find the biggest discount factors on a stock purchase. Now, I've been getting a lot of questions on NEO. Right now, NEO, because of the crazy implied volatility on it, it's a $46 stock. If you sell the $46 puts, you're collecting $7. That's a 15% discount on that stock purchase. So for those of you that are, interested in thinking about buying NEO, this might be a better alternative than trying to chase this stock at the current price. Now, that's if you think NEO is a good long-term investment. Now, remember, Selling put options are only for stocks that you want to purchase because that's what you're obligating yourself to do. We also talked about American Airlines the other day, when it's trading at $14. Right now it's trading at $16. If you sell the $16 put option, you're collecting $1.60. That's a 10% discount. So this is a report that's sorted for you based on annualized return. And what we do is we show you, it's sorted by the raw return, meaning how big of a discount are you receiving on your stock purchase. So what you can do is you can use this as a list of potential stock opportunities to research. Do you want to buy NEO? Do you want to buy American Airlines? Do you want to buy Tesla? Do you want to buy whatever this is? Maybe you really like the gaming stocks, the sports betting stocks like Penn Gaming, and you like this stock. So this is telling you exactly what expiration date, what strike price, how much premium you're collecting, whether it's a liquid stock or not, very important. What the IV rank is as well. So for those of you that like to sell stocks with high IV rank, you can use this as a filter. It'll tell you when the next earnings date is, and we have an earnings flag to tell you if there's earnings between now and the expiration date, what the current stock price is, number of days to expiration, and the actual discount factor that you're receiving. This annualized return is a good idea to give you a sense for how much yield are you getting on your cash that you have to put aside to sell this put. But this is a report that if you're interested in selling put options, or if you're interested in buying stocks, you should always look at this report. The next time you're thinking about buying a stock, find the stock that you want to purchase on this report, see what strike price we're telling you to potentially sell, and see how big of a discount you're actually receiving. Now, this is the S&P 500 stock, S&P 500 list. And from what I can tell, looks like, let's just look at 3%, right? So 3% is right here. So there are about roughly 380 stocks in the S&P 500 that if you, instead of placing a limit order, used a short put, you're going to collect at least a 3% discount on the purchase of your stock. So that's one way to potentially utilize this report to help you purchase or fund this, purchase the stocks that you want to buy at a discount. Now, this is a report that's available for all members here. We actually send you an email every Monday, Wednesday, and Friday. That's in the market observation email that gets sent out at 11 a.m. There's a link in that email that gives you a link to this report. That goes out to all members every single Monday, Wednesday, and Thursday. And we also have a cover call report. This is, again, similar type report that tells you exactly which stocks gives you the largest downside protection and the highest yield on the same list of stocks. So the cover call report looks like this. It looks almost identical, but it tells you exactly how much of a downside protection that you actually receive on the cover call. Now, the cover call report is more for stocks that you own. So you can just quickly look for the stocks that you own in your portfolio. Maybe let's say you own Pfizer in your portfolio because you think it's going to take off on vaccines. So this is telling you that Pfizer is currently trading at $40. We're selling the January $45 call option, which will give you a 3% downside protection. Now, here's the thing. Think about the fact that, Pfizer, if you own Pfizer, maybe you think the stock's going to $60 or and I'm just saying this as an example because, for some people you own Pfizer because you really think it's going to take off with the vaccine. So maybe you don't want to sell a $45 call option because that obligates you to get out of the stock at 45. If you think the stock's going to go to 60, don't sell the $45 option. Does that make sense? Think about the strike price that you're selling and ask yourself, if I had to sell my stock at this particular price, would I be happy at the end of that? Because the questions that I get all the time from investors that say, hey, I sold a cover call, the stock has gone significantly past it. What should I do? The answer is, are you happy with the stock price that you were originally obligating yourself to sell it at? If you are happy with it, let it go. You've made a profit, maybe not as much profit as you could have made, but at the end of the day, you're never going to be able to make the maximum amount of profit on a stock position. You have to be satisfied with a profit sometimes. So, 40 to 45, not a bad profit, but if you think the stock's going to go to 60, don't sell the $45 put. $45 call, but maybe on a different stock. Maybe, I don't know, let's take a look at some stocks here. what's one? Let's look at Uber, right? Uber's trading at $53. We're telling you to sell the $60 call option. Maybe you're thinking to yourself, well, I'd be happy if I, the Uber stock that I own from 30, 40 bucks, if I sold it at 60, I'd be really happy to do that. And here I'm getting a 2.4%, a 2.4% downside protection and a 22% yield on my cash. I'm happy with that. Or maybe Peloton, that's trading at 115 right now. The cover call that we're telling you to sell is 145. Maybe you're selling to yourself, I'm really happy selling Peloton at 145. So just ask yourself real quick before you sell your cover calls, am I happy letting go of the stock at this price? Only sell a cover call if you say to yourself, I am okay if I sold the stock at this particular price. Otherwise, you're going to send me emails, saying, hey, I sold the stock too early. What can I do? The answer is there's not much that you can do at that point. You can buy back the call option and sell another one. But at the end of the day, you're obligating yourself to sell your stock at that price. So be okay with that when you place that trade. So lastly, what I want to cover before we open this up for Q&A is the 3 scenarios that you'll find yourself in after you sell a covered call. Now, the reason I'm not talking about cash secured puts, because from my perspective, when you sell a cash secured put, there's really nothing that you have to do. You basically hold it to expiration and it either ends up expiring worthless or you end up owning the stock. Those are your 2 possible scenarios. That's what you want to happen, right? You either want it to expire worthless or you own the stock. When you sell a covered call, now here's the thing about a covered call. There are 3 scenarios that you might find yourself in, and different people will do different things. So I want to discuss it. So when you sell the covered call, there's 3 things. The stock can either go significantly higher, it can move sideways, or it can decline significantly. So in the first example, when the stock rallies significantly, this is where a lot of people will send me emails saying, hey, I bought a stock at $100. I sold the 110 cover call. The stock's now at 115. What do I do? The answer is, are you okay selling the stock at 110? If the answer is yes, you do nothing. You just let the stock get called away. You made your $10 profit plus whatever income that you received on the cover call, and you move on. You take the cash and you sell a put on a stock that you want to purchase instead. But if let's say you bought a stock at 100, you sold a 110. You sold a 110 call, and now the stock's at 115. And maybe, and this is a reasonable scenario where now that the stock's at 115, maybe you're rethinking to yourself, maybe you think that sometime in the future, the stock can keep going higher, right? Maybe this is like Zoom, right? Maybe Zoom, when it was trading at 100, it's at 115. You're thinking to yourself, hey, I think this thing can go to 130 or 150 or 200. If that's the case, you can hold on to your cover call and you simply want to roll your cover call 2 to 3 weeks from expiration. What that means is you buy back the 100 call, the 110 call that you sold, and you sell a higher call later that expire later, maybe a 120 or 125. But what you want to do is you want to buy back the call that you've sold, and then you want to sell a new call at a higher strike price, okay? So if the stock rise higher, that's what you can do. Now, in the second scenario, if the stock goes sideways, this is really kind of your best case scenario. You don't really have to do anything. You can hold that cover call until expiration and just simply let it expire worthless. Now, in the third scenario, when the stock drops, this is the only scenario where, from my perspective, it makes sense to potentially do something much earlier. So let's say you buy a $100 stock. Let's say you buy a $100 stock. You sold the 110 puts, and instead of going higher, the stock drops. So when the stock drops like this, the calls that you sold up here, maybe you sold these for, let's say, $2, they're going to be worth very little by the time the stock is down at, let's say, I don't know, $95 or $92. As the stock drops, this call option will drop very close to 0. So this is really one of the few scenarios where you can roll down your position fairly early. And the rule of thumb as to when you might want to roll down is if you can buy back your cover call for 20% of the premium that you originally sold it for. So if you sold something originally for $2 and you can now buy it back for, let's say, 40 cents, that's a good time to simply buy back the cover call that you sold, take the $1.60 in profits and maybe at this point roll it down to a lower cover call. Maybe at this point now sell maybe a 105 cover call. Maybe at that point you'll collect another dollar or $2 or something like that. And what you're doing is you're taking the $1.60 that you've earned very quickly, and now you're selling another cover call, maybe for another dollar or two, and you're increasing your income that you're receiving in a short amount of time. So those are generally the three scenarios that you'll find yourself in and how you should handle a cover call. So with that, that covers what I wanted to share with you here today. Now, I just want to do a quick reminder before we open this up for Q&A. Tomorrow morning, we're going to do the members only rapid fire session. This was a very popular session from 2 weeks ago, so we brought it back, and you guys have submitted over 500 symbols. So I'm really excited to do this. I was actually putting this, some of the things together here before this session, and we had over 500 submissions in terms of symbols. We're going to prioritize the ones that multiple people submitted. I think Baba was the one that most people submitted to look at. Baba, Tesla, Apple. There was a few, Palantir, Riot, also names that came up with a lot of requests. But we had over 500 symbols. I'm going to prioritize the ones that you guys, that multiple people submitted, and then the rest that were, if we can get to them, we'll sort by market cap, and we're going to go through them. I'm obviously not going to be able to go through 500 symbols, but we're going to get through as many as possible tomorrow morning. So really excited and looking forward to that session here tomorrow morning. And that's for all of you that are members to join us here tomorrow morning. So with that, I want to thank everyone for taking the time out here this afternoon. I really want to thank our members for supporting us and allowing us to continue to do this and build on all the education that we provide and build the tools and the resources that you guys are looking for. And membership is just $75 or $500 a year. So if you're currently on a free trial, I hope that you consider supporting us. It's going to give you access to the members only sessions like the one we're going to host tomorrow morning. And like I said, next Friday, we're going to be doing longer term thematic research. We're going to provide more fundamental research on some thematic themes. Next Friday, we're going to be talking about cybersecurity. We've been doing some analysis on the cybersecurity theme. We've identified multiple symbols or companies within that theme, and we want to show you which ones we like for that particular opportunity. And we're trying to find these themes that we think are going to do quite well from a fundamental perspective over the next few years. Everything from clean energy to cybersecurity to electrical vehicles. We want to do a deeper dive into each one of these themes that you guys have been asking us a lot about. So many questions over the past couple of weeks about electrical vehicles. So we want to do a deeper dive of that theme, show you the companies that are currently in that theme and which ones you might want to focus on. And it's going to work really well, in my opinion, for the LEAP options one that we're going to talk about here next Thursday. Taking advantage of some of those themes that we have, specific companies, and how to leverage longer term options to play those themes. So with that, thank you so much. At this point, what I'll do is I'll open this up for Q&A. So we do have the chat window and we have the Q&A window. I am going to ask, because there are so many questions, that please submit your questions in the Q&A window. That's where I'm going to answer your questions here today. So please, if you've submitted a question here in the chat window, please just type them into the Q&A window, and I will try to get through as many as I have time for here today. So Jacques is saying, great work, Tony. I've initiated a cover call on 2 stocks that I can't afford to get rid of. Both cover calls are getting in the money. I don't see any choice but to roll them. Since I am at a big loss with both cover calls, I don't see any choice but to wait at expiration to roll for the next expiration date. Do you have any suggestions? So Jacques saying, is in a position that I think many cover call sellers find themselves in. Now, Jacques, what I don't really understand in terms of stocks that you can't afford to get rid of. If you mean that stocks that you want to hold on to, number one, I don't suggest that you sell cover calls that you don't want to get rid of, right? So cover calls are really for stocks that you're okay with letting go of. That's number one. Number two, as far as, you say that you're at a big loss with both cover calls. Now, that's not an actual loss, because the loss that you have on the cover call is a gain in the underlying stock. So it's a paper loss, but it's not an actual loss in your portfolio. But it is going to cost you some money in order to sell those to buy back those cover calls. So the only way to do it is if you can roll them to a further call and collect quite a bit of premium that offsets the debit that you need to buy back those calls. You know, at the end of the day, there's no magic bullet that can lower the cost of buying those calls back. The thing that you can do is let the calls expire, let the stock get called away, and simply buy back the stock you know, the following Monday. That is one way that you can potentially avoid having to buy back those calls, because again, it's not a real loss. It's just a paper loss that's offset with the gains that you have in the underlying stock. Talia is saying, I bought a cover call and a cash secured put against DDD that I have in my portfolio. Meanwhile, the stock shot up a lot. I'm now at a negative 1,000 unrealized gains. Since the date to exercise is tomorrow, I need to decide whether to exercise and keep DDD stock or let someone buy out the shares. How would you be playing this? So, you know, the question as to whether or not you should let a cover call expire worthless, or if you should, I'm sorry, the question as to whether or not you should let the stock get called away, or if you should buy back the calls, is really dependent on whether you think if you think the stock's going to continue moving higher. And it's perfectly reasonable that you think the stock's going to keep moving higher. If that's the case, you know, you can buy back the call and sell another cover call. But it really is contingent upon whether you think the stock's going to continue moving higher or not. Wayne is saying, hey, Tony, I took a position on a cover call with a buy right and a 53-day expiration. The stock rallied quickly. Okay, so I'm starting to see basically, you know, the same questions being asked over again. And this is fairly common, Ken. And this is why I keep going back to this point. How important that I say when you're selling cover calls, find strike prices that are far away. It should be a strike price where you say, I don't think the stock's really going to get to that point, because that's how the cover calls should be. You know, every investor, I keep finding this, investors prioritize income over capital appreciation. And when the stock rallies, they're kicking themselves because they lost out on a lot of opportunity. That's why whenever we're selling cover calls, I actually prefer selling, you know, 15 delta, 10 deltas, something that has a very low probability of getting called away, because yes, I'm going to collect less income, but I rarely find myself in this position where I'm, you know, at a huge loss on a short call, because that's why I'm selling calls that are very far out of the money. You know, Wayne, Talia, you know, everyone's asking, I think, very similar questions. And the way to avoid this, number one, is to sell cover calls that are far away. Don't sell cover calls in stocks that you don't want to sell. Okay, that's number one. That's number one. Don't sell cover calls in stocks that you don't want to sell. Sell cover calls that are really far away, 10 to 15 deltas, in my opinion, if it's a stock that you don't want to get called away. And you know, if you do find yourself in a position where the stock did jump and you think the stock's going to continue moving, then buy back the call and sell another call option at a further dated option. When doing a cash secured put, is it advisable to put a stop order to short the stock in case it drops too low? You can, Jock. Yeah, absolutely. So if, let's say you sold a put option for $2, you can put a stop order at, let's say, $5 or $6, so that if you get a big drop in the stock, you at least stop yourself from doing that. And you absolutely can do that. David is saying, when GM was at 30 in October, I sold the December $38 call. How badly should I feel about that? From my perspective, I don't think you should feel bad at that at all. That's an $8 move in the underlying stock in 2 months. You should feel good about that you were able to capture that and take profits. And at the end of the day, you're never going to be able to buy at the very bottom and sell at the very top. That's just unrealistic. And unfortunately, that's just how life works. You know, you're never going to be able to catch the top. And Dave, I think, you know, buying at 30 and selling at 38 for a 2-month trade is really not bad. You're talking about, you know, a 20%, a little over 25% return in 2 months. What is the delta and time frame best for selling puts? I think that's exactly what we talked about here. 45 days to expiration, about 30 to 40 deltas for puts. Can you not sell a cash covered call? No, there's no such thing as a cash covered call because a covered call, a naked call has unlimited risk. You can sell a naked call. So that's effectively what a cash covered call is you have to put up margin in order to sell a naked call. Harley is saying, could one also carry a stop or limit order while having sold a stock on? Could you? I think Harley's question is, can you have a stop or a stop limit on the stock that you've sold a cover call on? Harley, that's a great question. I think what you can do is you can put a stop limit on the full position, the buy right position. So let's say you own 100 shares of the stock, and let's say you've sold a call for $1. That means your net is $99. You can put a stop on the two positions combined. So if the stock drops, that you basically exit both the stock and the short call in one order. So you should be able to do that, Harley. Shanti is saying, is it okay to sell cover calls if there's an earnings event in that month? So you can, but that's a risk that you're taking, that the stock then sharply increases, goes through your strike price, and now you've obligated yourself to sell your stock at a price below where the stock is trading. So I generally don't advise doing it, but you can. There's nothing that stops you from doing it. Maybe explain that the trade is called covered because you must own the shares as opposed to naked. So yes, when we talk about a cover call, it's covered call because you own the stock, but you can also sell a naked call, but I don't advise selling a naked call. I don't really see a great reason to sell a naked call and take on unlimited risk. I think you're better off selling a credit spread in that particular case, in my opinion. Talia, the price was much above the strike price, but it still isn't exercised. 1,400% of unrealized, a lot of unrealized gain. Talia, I think you're going to have to expand a little bit on that. If that's in regards to the first example, I'm not exactly sure what you mean by that. Mitch is saying, did you cover rolling over the expiring cover calls? When is this a good / optimal strategy? That is something I did cover at the end there, Mitch. Christine is saying, if a cover call causes the stock to be called away, will this affect the cost basis of the stock? If so, does the brokerage firm typically adjust this at the end of the year for tax purposes? So just to be clear, the cover calls that you sell will not adjust the tax lot of the stock that you own. It will simply just change the effective cost basis, but it will not change the cost basis from a tax perspective, Christine. Jeff is saying, if I sell a put, but the stock price falls afterwards, what's the strategy I could take other than buy back the put if I do not want to buy the stock at the strike price? Jeff, the only thing that you can do at that point, so the question is, if you sell a put, let's say I sell a $44 put on GM and the stock drops after I sold the put to, let's say, 35, and I no longer want to buy the stock because maybe some news comes out that's changed my outlook on GM and I no longer want to buy this. I no longer want to buy the stock. The only thing you can do is to buy back the put. That's the only thing you can do and get yourself out. Can you trade it afterwards because you think it's going to bounce higher? Or you think it's going to keep going lower? You certainly can, but you're taking on more risk then. The only thing to do is simply buy back those puts and move on. Why avoid selling going into earnings? Usually price drops around 3% prior to earnings. Talia, I've never heard that statistic. I'm curious to see as to where you've heard that statistic or where you've found that statistic, because I certainly have never seen anything that remotely resembles that. Jock is saying, is it relevant to do cover calls if the stock has a low implied volatility? So Jock, low implied volatility does not mean that implied volatility can't get any lower. So that's a common misconception that people have with implied volatility. People just think that if it's low, that you got to buy vol. If it's high, you got to sell vol. Just because vol is high doesn't mean they can't go higher, and just because vol is low doesn't mean it can't go any lower. So, or just stay stable, right? Because as long as vol doesn't spike up, selling vol is a perfectly reasonable strategy. So I don't think low vol is a reason to not sell, in my opinion. What happens when you have a cover call and the stock pays a dividend? Nothing. You get paid both the dividend and the income from the cover call. Arnaud is saying, if you own a cover call, does that mean you cannot sell your stock until expiration? Arnaud, that is true. Unless you buy back the call option, then you can sell your stock before expiration. Peter, you can't access the report from the website at the moment. You can only access it through the email that we send out to you on Monday, Wednesday, and Thursday. Chris is saying, if we prefer selling put spreads, is the optimal short put report still helpful for that purpose? Chris, yes, it is, because you can still use the strike price as your short put strike. So if, let's say you want to sell put spreads on Baidu, the 140 strike price is still a suitable strike price for you to sell. You just have to buy back roughly the 25 delta after you sell the close to the at the money strike price as you have here in this report. Hi, Tony. Can we find this list on the platform? So Raheem, we're currently in the process of adding this report to the platform. But right now you can access it through the email that we send to you on Monday, Wednesday, and Friday that we send out to members at 11 a.m. How would you handle a cover call on Tesla, given it is about to be added to the S&P 500? I see it on the cover call list at an 800 strike for the January 15th expiration. Jeffrey, from my perspective, adding to the S&P 500 is not in reality, it should not be a real event here. I mean, we do expect some buying here on December 18th, which is the day before the stock is added to the index. We expect portfolio managers to be buying about 100 million, 120 million shares of Tesla on that specific date. So that obviously is going to likely cause some volatility, but a lot of investors have front run that particular trade, and I think some investors are going to try to sell on that date. So I mean, I think December 18th is just going to be a volatile day for Tesla. To be perfectly honest, we've never had a stock join the S&P 500 as number 6 in the list. They usually join much lower when they're still in the 400, 300 range, where they're a much smaller weight, and the amount of buying of that stock is relatively small. We've never had a stock join this late in the game, or a stock that has rallied so much in terms of market cap before it was joined. We don't really have a template as to what's going to happen on December 18th. From my perspective, I think you're going to likely see a lot of volatility. You're likely going to end the day up higher, in my opinion, because you have to buy so many shares. But I also expect a lot of investors to be selling on that day to those institutional buyers that have to buy the stock on that date. So it's just going to be a volatile day, in my opinion. Michael's saying, what happens when the strike price is realized before expiration? I'm not sure what that means. When it bounces higher at expiration, the opportunity is gone. Michael, I'm not sure I understand your question. If you don't mind clarifying, I'm happy to answer that question. I don't see the spreadsheet you showed earlier on your website. So Bernard, it's not on our website currently. This is something that we're currently in the process of adding a members only website where all of this will be embedded into that website. But we're still about a couple of weeks away from launching that website. Members of Chaikin Analytics, you don't have access to these reports, unfortunately. You only have access to the options play tools embedded into Chaikin Analytics. Thomas is saying, in cases of selling a cover call and strike prices in the money at expiration, do you recommend to let the exercise complete on the broker platform, i.e. sell the underlying stock, assuming you're still happy to exit the stock in the selected strike? Thomas, yes, that's what I would do. I would let the stock be called away, and then you've effectively sold the stock at the strike price that you were looking to sell your stock at. David is saying, Tony, thank you for the excellent education. I have learned my lesson using cover calls when I found the stock moving over the strike price and realized that unfortunately I didn't want to sell at the strike. What I did was quickly purchase an extra 100 shares at the strike price and let these new 100 shares be called away. My question is, what are the pros and cons of this process, assuming I have the money? David, I don't know what you mean by the pros and cons of that process. I mean, at the end of the day, the two are equal. Whether you let the stock get called away and buy more stock on Monday, or you buy back the call option, the two are net from a P&L perspective equal. They're not, one is not beneficial than the other, in my opinion. The question is just, it comes down to transaction costs, right? Meaning, number one, what price can you buy the stock back at on Monday morning? Or whether if you buy it on Friday night before because you have the cash, like you said, it really just comes down to the actual execution. If you can buy the stock at a lower price than what you sold the stock price for, then in my opinion, you can potentially get a little bit of an advantage, but that advantage, in my opinion, is fairly small. Angela saying, when is the earliest and latest date from expiration you would want to buy back and roll for a cover call? So the earliest is probably about 3 weeks. The latest is probably 1 week before expiration. Keith is saying, how do you access the reports directly through my options play account? So again, Keith, we're in the process of building a members only website where all of your members only content will live. But like I said, we're about 2 weeks away from launching that. Yes, this webinar is recorded. Pardon my complete ignorance, but can you walk us through exactly how you acquire shares by selling puts? Jay Bell, I recommend that you go back and watch the recording. This is a short put. It is, once you sell a put, as long as the stock goes below your strike price, you will own the shares. I mean, you don't have to do anything. Your brokerage firm will actually deliver the shares into your account, if that's your question. As long as the stock is below your strike price at expiration, if you do nothing, your brokerage firm will purchase the shares for you. Sure. What are your thoughts about Chinese stocks that are trading in the US, considering what Congress is planning about financial visibility? Is it worth selling puts or cover calls? So sure, I don't know that selling puts would be the right strategy here, because any concerns that you have would drive the stock price down. So selling puts on a stock that you think the price is going to go down is not a good strategy. You don't want to buy a stock that you think is going to go down, nor is selling cover calls, in my opinion, the best strategy either. I think that if you're really trying to play for potential downside here of Chinese companies being delisted, or having to go through a different regulatory process to be listed, you're likely going to see downside. You might want to buy puts or sell some credit spreads, in my opinion. How are you calculating that annualized return? Great question. Eric, I don't have time to write math formulas out right now, so I think if you send me an email at info@optionsplay.com, I'm happy to share with you how we calculate annualized return. Wayne is saying, for IV crushes, there are a few stocks reporting earnings at this time with weekly options. However, there are more with monthly options. Are monthlies okay to trade? Anything special to be aware of versus weeklies? Wayne, I'm not sure I really understand your question with respect to, weeklies reporting earnings versus monthlies. I mean, weekly and monthly options are identical options. It's just weekly options are listed more often. So from a trading perspective, they're identical. There's no difference. So there's no advantage to trading weeklies or monthlies. Sandra is saying, on the GM purchase screen, is the right side supposed to be declines of 44 as the left side? Yeah, because both sides are effectively triggered when GM, oh, sorry, you're right. This should say 44. Good catch, Sandra, you're absolutely right. This is until GM declines to 44, not 42. Ron is saying, is there a PDF version of the cover call / short put report? It's not big. I'm not big on the spreadsheet view. Well, the spreadsheet view is so that you can filter and sort. That's why it's in a spreadsheet form, but you can download it in a PDF format if you'd like. You can go to File. You should be able to download in a PDF document if you'd like to download as a PDF. But I don't recommend that, because then you're looking at hundreds and hundreds of rows. You're better off just filtering if you want to see it by a specific symbol, or if you want to sort by liquidity. You can do that just on the spreadsheet. Ellen, if you have a request for a symbol, please type them into the request for tomorrow morning for the rapid fire session. Right now, I'm not taking requests for individual symbols to look at. That's what tomorrow morning session is for. Harley is saying, with either cover call or short puts, should one consider a yield floor as part of the selection criteria? Generally, yeah, I would say that on cash secured puts, I don't like to sell cash secured puts for under 2%. On cover calls, I usually don't like to go below, volatility right now is pretty high, so it's pretty easy to find cover calls that collect 1.5, 2%. But when things were really low, like in January, 0.6%, 0.7%, that was on the low end of the cover call. What are the risks or downsides of selling cover calls? I would say the downside is that you choose a strike price that's too conservative. I'm sorry, too aggressive, and the stock shoots through your strike price, and you miss out on those gains. But there's no downside in my opinion. There's just lost opportunity on a cover call. When selling or buying, which is better, in the money, at the money, or out of the money? Whenever you're buying options, we're talking buying calls, buying puts, you always want to buy near the money. So at the money, slightly in the money is where you generally want to start. Eric is saying, fell out of the webinar a couple of times. Is this recorded? Yes, this is recorded, Eric. Terry is saying, how to transfer transaction from platform to profile, shared transaction. How to transfer transaction from platform to profile. Terry, I'm not sure I understand your question. Could you possibly write that? Naeem is saying, I have sold cover calls 2 years out on Palantir at 35 with my buying at 35. This is a good scenario. Naeem, you should never, ever sell cover calls that are 2 years out. There's no advantage to doing 2-year options, because if we look at Palantir, all right, it's trading at $24. You sold the 30 January, 2 years out, which means that you sold. This is a good question. I think this is a good example for everyone, right? So you sold the $35 call options. You collected $9, right? So that's 24 to 35. That's about 10, 11 bucks in potential income, potential upside, plus another $9 in the premium that you collected, right? That sounds pretty good, but that's $9 in 2 years. Let me show you this. In 45 days, if I sold the 30s, let's see, 24, right? Let's say I sold the 30s that expire in January, right? So you chose 35 2 years away. I chose the 30s less than 2 months away. I'm collecting $2.50. If I do this just 4 months in a row, I'm already collecting more money in 4 months than you are going to collect over the next 2 years. This is why you never, ever want to sell cover calls much longer than 45 to 60 days out, because you're just not getting much income. You're getting here $2.50 for every 43 days. You're collecting $9 for a full 2 years. You're severely underperforming on that. So Naeem, my suggestion to you, buy back those 2-year calls, get out of those calls, sell January $30 calls. That gives you, in this particular case, and you can even go a little higher, right? You can go to 32, collect $2.05 in this particular case. In my opinion, that's far better. This gives you a lot more upside, almost as much upside here, and the stock doesn't have to run, has to run in this particular case basically almost 50% in the next month and a half, and you're collecting a fifth of what you were going to collect over the full 2 years in just a month. So I would highly, highly recommend that you buy back those calls and sell shorter dated calls. Michael, you're very welcome. Michael's saying, is it a good strategy to sell cover calls if you are concerned about a downside coming, or you should take profits? So Michael, that depends on how big of a downside you're concerned about. If you think there's a major correction coming down, don't sell cover calls. Either buy puts or get out of the stock. If you think there's going to be a mild downturn, then yeah, selling cover calls, in my opinion, is a suitable strategy. Do you think you could ever use these strategies for cryptos? Obviously, Bitcoin is too expensive now, or could you sell a put? So from my perspective, the amount that the stock is trading at doesn't really matter, right? So you can do this on Amazon stock that's trading at $3,000. You can do it on any stock that's trading. The difference is the fact that just how many contracts you can trade. So from my perspective, it really doesn't have anything to do with the price, if you will. It just has to do with the volatility of it. Bitcoin's extremely volatile, which means that you're going to collect a lot of premium for it. look for a strike price just above the expected resistance line. So Keith, you can also use resistance to do that, but from my perspective, if we use backtesting, you want to use a probability-based approach to selecting your cover calls. That's why when we use strike prices, we use deltas to choose our strike prices. There's another question. Dean is asking about Unity, and he sold a February 2021 put, collects a nice premium. So I don't think February is too far out, but I do think that you're going to collect more premium if you sold a January call and put and did it more often. But you know, and here's the thing: is that the reason that you don't want to sell a long-term put is because if the stock declines to your strike price, you sold a $100 put. So here's the thing: is that selling a $100 put in February has very little probability. You know, a $100 put is a 17 delta. You have a 17% chance of owning the stock. That's not a probability that I want to take, right? You're taking on only $9.20 in premium, which sounds like a lot, but on a stock that's this volatile, in my opinion, you're better off, if you really want to own the stock, sell maybe a 130. You're going to collect $22 in premium. It's a 15% discount on the stock purchase. From my perspective, I'd rather get a 15% discount and a 30% of owning the stock rather than a, in this particular case, a 6% discount with only a 17% chance of owning it. You get a smaller discount and a smaller chance of owning it. So don't sell long dated puts because of that reason, and don't sell really far out of the money puts as well. Michael's saying, are you saying it's better to sell a losing position and buy another stock than try to get the stock back by selling cover calls? Yes, that is exactly what I'm saying, Michael. Sometimes I see spread expirations further out that are priced at the same or even lower than those about 45 days out. Intuitively, they look like a better deal. Are they? Why would a spread further out? If you're talking about a debit spread, like when you're buying a spread that's priced lower at ones that are further out, I would be weary of those prices because that's just not possible. That longer dated options cost less. I think what you're talking about perhaps is an option that's not very liquid, and you're comparing a weekly option that's not very liquid to a monthly option that's more liquid, and the weekly option looks more expensive, but it's not really because the spreads are really wide because they were just listed. That's the only reason that I would see that. If you see a longer dated option that's cheaper than a shorter dated option, something is wrong. Talia, thank you for the answer. If I feel the stock has much more room to grow, wouldn't it be better to just buy calls again? Yeah, well, not necessarily, because call options can be very expensive, right? So here, look at Unity. The 145 calls will cost me $2,500. So, you know, that's another thing that I think most investors kind of glance over and don't really spend too much time to learn. And I think it's one of the most important things to learn is that buying call options is not a bullish strategy. Buying call options is a bullish by a certain amount strategy. And what amount is that? It's the amount that the call options cost, right? So this call option costs $1,000, then the stock would have to go to 155 in order to break even. But because this costs $2,500, Unity has to go to 170 just to break even. So you have to ask yourself, do I think Unity is going to be above 170 by January? If you think it's going to be at 170, don't buy it because you're not going to make any money. You're only going to make money if Unity's above 170. So 180, 190, that's when you're going to make money. So ask yourself, do I think Unity is going to get from 145 to 180 or 190? If you do think it's going to be there, then buy the call options. So just buying calls because you think it's bullish is not a good idea. But as you say, Talia, you think there's much more room to grow. So, you know, ask yourself, do I think it's going to exceed the break-even price? So on this particular, it's $170. Do I think by January, the stock's going to be above 170? If the answer is yes, then buy that call option. If the answer is no, don't buy that call option. Kevin, to your question about, do members of Chaikin Analytics get a discount to your services? They do. So if you send me an email at info@optionsplay.com, I'm happy to set you up with that. Ron is saying my credit card my covered call were 45 days out on low delta and still became a problem. You haven't mentioned wanting to keep high dividend stocks as opposed to expecting a rise of stock. Ron, I'm not sure what you mean by I haven't mentioned wanting to keep high dividend stocks as opposed to expecting a rise of the stock. Ron, if you don't mind clarifying, I'm happy to answer your question. But if you selected a 45-day option and a very low delta, then you did very well on the underlying stock. That means the stock has rallied significantly, especially on a high dividend paying stock. You should be happy about that rally. I mean, that means that the stock had to have rallied significantly for it to reach your low delta strike price. That's an outsized move of the underlying stock. Those are the opportunities that you want to take profits on and move on to the next trade. You can buy back that stock if you want, but take advantage of that. Take some profits, lock in those profits, buy back the stock if you really like it. In Canada, we have a 30 days of superficial loss tax low, which prevents to take tax advantage. Anil, I'm not a tax specialist or a tax professional. I certainly don't know anything about Canadian taxes, so unfortunately, I don't have anything to comment on that. Christine is saying, is it ever advisable to sell puts further out in time than 45 days? So Christine, just like that example I just showed you in Palantir in terms of that person who sold the 2-year call option, it's not advisable in my opinion, because number one, you're lowering your potential of owning the stock, right? So if let's say I sold this, even if I sold, let's say it sold a January 130 versus a February 130s. Now, if the stock dips below 130, let's say by January, and then starts to rally after that, guess what? If I sold the February puts, I don't participate in that because the stock has to be below 130 on February 19th. So the further out you go in time, the less certainty you have as far as whether the stock's going to be below that strike price. And think about it, you're buying stocks on, you're selling puts on stocks that you want to own. Generally speaking, stocks that you want to own are stocks that you think are going to go higher. So you don't want to sell something really far out, because what if the stock goes lower and starts to move higher? You're going to miss out on those because you're sold something that's too far out. So don't sell something that's far out on cash secured puts. What about selling the put and simultaneously selling a call? So that's selling a strangle, and that's a completely different strategy than what we're talking about here today, Eric. A strangle is really for a stock that you think is not going to move very much, especially a stock at a relatively high implied volatility that you think is going to come down. That's really more of a neutral strategy and does require a lot more in terms of, and it does require a lot more capital to do so. If your call is deep in the money with a lot of time left, how often or how many days left should you roll it? Patrick, usually about 2 to 3 weeks before expiration is a good time to roll a cover call that's now deep in the money. Is this strategy IRA friendly? So JQ, great question. It is an IRA friendly strategy. The only downside to this strategy in an IRA is that sometimes when you sell it, if let's say you don't have a lot of extra cash in the account and you have most of your IRA invested in stocks, you may find yourself in a position where you want to buy back a cover call and sell another one, but you actually don't have the cash to do so because you can't deposit more money into an IRA as freely as you would on a regular brokerage account. In that particular case, you're forced to basically sell the stock, but because you don't have any capital gains consequences in an IRA, that generally speaking is okay. And then what you do is you simply buy back the stock the following Monday. But that is one of the limitations of doing this in an IRA. What does it mean to buy back your put? It's exactly that. So when you sell a put, you sell to open. When you buy back the put, you buy to close. This is something that I actually cover on my video. If you follow us on YouTube, I will send you a link here. We have a video on entering option orders on our YouTube channel. I highly recommend that you take a look at that. I just posted a link into the chat window to our YouTube channel. And like I said, there's a video on entering and exiting option position and orders. So please take a look at that. But you sell a put, sell to open, a put to enter. You need to buy to close in order to exit that. If you don't know how to do that, call your brokerage firm. Have them walk you through placing that order. James, my greatest learning from you is trading free. I love assignments and always making money as it gets called away. James, I completely agree with your sentiment. A lot of questions here today were around not wanting to get assigned on a short put or not wanting to get assigned on a cover call. But you should really think about assignments as a positive thing, because if your cover call is assigned to you, that means you made a profit on the stocks that you owned. The stock reached your target price. Granted, the stock may have exceeded your target price, but that doesn't mean that you didn't make a profit. So I know it feels uncomfortable to miss out on gains, right? Because that's just who we are as human beings. We have this fear of missing out. But when your stock gets called away, that means the stock reached your target price. You were able to make a profit on that trade. Be happy about that. That shouldn't be a sad moment. So James, I completely agree with your sentiment. Eric is saying, how are you calculating the annualized return? So Eric, again, send me an email. I'm happy to write you the formula here. Would a straddle make sense on Tesla given the unknowns with vol? I don't believe so, because I simply think that Tesla vol already is very high. I think it's no secret that what's going to happen. So it's not like you're the only one who knows and no one else knows and you expect vol is going to expand. Everyone already knows this. Everyone expects volatility to be high on that day. So I don't particularly think that it's a great idea to buy straddles on Tesla. Tesla wouldn't institutional buyers be buying now? No, they have to buy the day before it gets added to the index, because or else they're going to have tracking errors. They want to buy as close to the actual time that Tesla is added to the index so that their tracking error is as close to zero as possible. So if you look at SPY, if they started buying Tesla today and Tesla started going up, they're going to start skewing up the tracking between SPY and their actual portfolio. So no, they have to buy it as close to the actual addition to the index itself, which is going to be on December 21st, which means that they have to buy near the close of December 18th. Ron is saying taxation is the difference in the last guy's question. I'm not sure I remember that question. Naeem, regarding your question, I have answered that question, Naeem. If you sell cover calls, you need to pay the dividend and it will cancel out your dividend gain on your holding stocks. If you sell cover calls, you need to pay the dividend. No, it's not canceled out. I'm not sure where you read that, CC. Please let me know where you read that you think that the cover call cancels out your dividend payment, because it definitely does not. Say GM short put 44 happens before expiration, but at expiration GM's at 50. How can I own the stock then? You don't own the stock if the stock's at 50 at expiration. If the stock's at 50, then all you keep is a $2 that you collect on the short $44 put, Michael. Do you have broken wing butterfly lessons on YouTube? Sanjay, I do not have broken wing butterfly lessons on YouTube, but that is something that Tom and I have talked about on our sessions. So you can look up on our YouTube channel. I have done sessions with Tom Sosnoff where we have talked about broken wing butterflies. It's during our strategy session. If you look up at the strategy session on YouTube channel with Tom Sosnoff, we did cover that strategy. Monthly and weeklies are different when buying calls or puts on indices like SPX. How are buying calls or puts on indices like SPX different between monthlies and weeklies? Jay Miller, if you can, I don't really understand why you think that's different. LUV trade today due to layoffs. Do you think it will go down? Should we exit? Generally speaking, layoffs are not generally seen as a negative for most stocks. They're generally seen as a positive because it's a cost saving metric. It's certainly not great for the people who are laid off, but for the company, layoffs, generally speaking, are a net positive because it's a cost savings for the company. Any idea on a leap covered call? I'm not sure what you mean by any ideas on a leap cover call. If you don't mind clarifying. Do members need to register for the rapid fire session? Yes, when you log on to your Options Play account, you'll get this pop-up here. You can click on register now. So just log into your Options Play account and click on register. Warren is saying, in your experience, is owning the underlying better than leap options when writing cover calls? So owning the underlying when you're selling cover calls just makes it a little cleaner, because when you own a leap, and the stock goes above the strike price of your cover call, your call's not actually technically covered because you don't actually own the stock. So you can either buy the stock and then deliver it, or you exercise your leap in order to deliver it. But it never makes sense to exercise a leap early because you're effectively giving up the extrinsic value that you paid on that leap. So it's not as clean when you sell a cover call on a leap versus if you actually own the underlying stock. Is it better to sell cover calls 4 times using weekly options versus selling a monthly option? So JB, this is a great question. The answer is that if you just think about the income amount, the answer is yes. But what you're not considering is the fact that when you sell weekly options, so let's say I go to Apple, and this is that concept before, right? That when you sell a 2-year leap cover call that I showed you before, when you sell that 2-year leap, versus selling the 1 month leap, 1 month cover call, you collect a lot more income if you sell 1 month calls every single month for the 2 years than if you do for a 2-year option. JB's question is just, what if you took that to the extreme level and sold weekly options? Can you collect more income selling weekly options than you can doing the monthly options? And the answer to your question is that if you're focused on just income alone, the answer is yes, you're going to collect more income, but you're going to give up a lot more upside when you're doing those weekly cover calls, because you're going to get called away a lot more often. You're going to constantly have to figure out how to buy back the stock that you own. So when you add the two net together, you actually end up in a worse position than if you sold the cover call, that monthly option. So that, the answer is yes, you'll get more income, but you're going to add a lot more headache. You're going to a lot more transaction costs, and you're going to have a lot more opportunities to potentially miss out on gains of the underlying stock if you sell weekly options. And when we back tested this strategy over the long run, the two roughly net out to be equal once you add in all the transaction costs and what your lost opportunities are when your stock gets called away, maybe like 2 out of the 4 weeks or 1 out of the 4 weeks. Once I choose a trade from the platform, how do I save it So great question. So if you choose a trade on Options Play, let's say you're looking at this January call option here and you want to save it, what you have to do is you can click on the blue share button, and we have this link button here. You click on that link, and what that will do is that will save the link, and this will save the link for your profile. And you go to the Options Play link here in the upper right-hand corner. You click on Profile, and it's all under Save Trades. So you'll see all of the trades here, right here under your Save Trade section under your profile. Okay, I've really tried to get through as many questions as possible. I unfortunately cannot get to all of them. We've already spent almost 45 minutes answering questions here, but I really appreciate everyone taking the time here, participating here today, asking questions. I enjoy doing this as much as you guys enjoy watching this, so I really appreciate you taking the time out. I'm really looking forward to tomorrow morning's rapid fire session. I hope that for those of you that are members, you're able to join us for that. A lot of you have found a lot of value in that, which is why we brought that back. And if you're not a member right now, please consider supporting us, and you'll be invited to the members only sessions like the one we're hosting tomorrow morning and the one we're hosting next Friday on our cybersecurity thematic investment research. So we want to share with you that. I'm really looking forward to sharing that with our members. Thank you so much. I hope you have a great trading day. These are recorded, so you'll be able to have access to them starting later this afternoon. So thank you so much. Have a great evening, and I'll see you guys tomorrow morning.